What's the real difference between the top 1% of profitable option traders and the other 99% who lose money? It's not what most people think it is. It's not just that they have stronger discipline and a better control of their fear and greed. These things matter, but they're usually a symptom and not the root cause. The real difference is how professional traders see the market, because they're looking at the market through the lens of value, and they're constantly asking themselves one question: is the option I'm looking at fairly priced? So let's talk about how pros actually think, how they find edges, and how you can start looking at the market in the exact same way. Pro traders play a pretty simple sounding game. Buy cheap things, sell expensive things. On the surface, extremely simple to do, but in reality, you need to actually understand how options work, and you need to understand how to think about the market that you're participating in, what motivates buyers and sellers, and what actually drives the value of the asset that you're trading, in this case options. Professionals aren't just watching a price chart tracking every single move, trying to see when things break above a particular line. They're playing a more holistic game where they look at the market and try to identify areas where things might be mispriced. A very easy example to look at is the out-of-the-money puts on indexes. If you look at the market, you'll see that the out-of-the-money puts tend to be the most expensive or high-priced options on the chain. Why is this? It's because that's what everyone goes to buy when they want to hedge their downside risk. Now, logically, it makes sense that if we look where all the demand is going, it's likely that that is where we will find something that's expensive. And then we can take that logical idea, test it historically, and see for ourselves that actually, yes, that is where implied volatility, or the price of options, tends to overstate the realized volatility, or how much you actually pay out when you're shorting those options over time. But bringing this back to basics, the first thing you need to do if you want to think like a professional is understand how options as a product actually work. You see, options aren't just some leveraged bet on the direction that a stock is going to move. Their value is actually shaped by a multitude of factors: the volatility, the time to expiration, interest rates, dividends, and the relationship between the strike price of the option and the underlying stock itself. These complexities that make options a little bit trickier to understand tend to scare most people away, but it's also one of the reasons that professionals and some retail traders look at them in particular as a place where edges can be found. Those who understand the nuances of options, combined with a good view of the market, are able to find opportunities that others usually miss. So of course, the first step to thinking about options like a professional is to understand how options themselves truly work. Once we've done that, we get to really the crux of this discussion, which is that the defining trait of a profitable options trader is price sensitivity. When a professional sees an option that is trading for $5 right now, their first thought is not just, this could double in value to $10. Is the option I'm looking at actually worth $5? This means what they're doing is taking the market price of the option and comparing it against their own fair value of what that option should be trading at. If they think the option's worth $4, well then that $5 option should be sold. If they think it's worth $6, then they should be buying it. In options terms, they're looking for the difference between the premium they could collect for the option versus what they would have to pay out on average, or the premium they would pay for the option versus what it should appreciate to on average. A super simple example of how professionals think. Imagine you saw a $5 bill on eBay or something, and it was being sold for $2. Well, of course you would go and buy that $5 bill, right? Because it's worth $5 in its fair value, and it's currently trading for $2. You can immediately buy it and turn it around for a profit. So in the same way, if you find an option that is worth $3 and the market is willing to buy it from you for $5, well, of course you go out and you sell that option. Now, of course, all of this sounds very obvious in our super simplified arbitrage example, but in reality, this is much tougher to do. Pricing options is something that the market is pretty efficient at. And so that's why a lot of the times what we do in predicting alpha, for example, we simply measure the price of options and try to find areas where the market is systematically willing to pay a premium to transact with us. This would be things such as selling those out-of-the-money options on ETFs or selling options around earnings events. And so if you want to actually learn those strategies, you can click the link in the description below and take a 7-day free trial with us at PA. We focus on boring strategies that actually make money. And so if you're an option seller looking to trade things that just work, click the link and check out the strategies. You will not regret it. In a recent video, we talked about a concept called expected value, and everything we're talking about in this video really ties back to that concept. You see, the difference between the market price on average and the price that you calculate as your fair value is your expected value. And if you are consistently trading in situations where your EV or expectancy is positive, then you should on average make money running your strategy. And so this is the mindset that separates the pros from everybody else. While most traders are working on controlling their emotions, Professionals are working on controlling value. And so yes, the 1% of traders that are winning, they do think differently. But it's not some hidden secret that we are unable to do for ourselves. They just understand the mechanics of options at a deep level and are extremely price sensitive. That combination lets them find and exploit opportunities that most traders don't even know exists. So if you want to join the top 1%, stop just thinking about the direction that a stock is going to move. Understand the product you're trading, start thinking in terms of expected value, and you'll find yourself well on the way to running a profitable book.